Good evening. Today we are going to look at budgeting. Budgeting. Budgeting is a fundamental tool in management accounting that facilitates effective planning, control. Budgeting facilitates effective planning, control, and decision making. Within an organization. It involves the preparation of detailed financial plans that outline expected income, expenditure, and resources allocation over a specific period. Often, it is a financial year. But budget is usually prepared in an annual basis. Then a budget is a formal financial plan that covers all activities of an organization for a specific period, typically 1 year. It outlines expected revenues. Expenses, and allocation, resources allocation to guide decision making and performance. And organization activities expressed in financial type, usually within a specific period of time. And this typically is 1 year. The whole activity compressed in 1 year, interpret in financial terms. Then importance of budgeting. Importance of budgeting system. Why budgeting? Why budgeting? So the importance of budgeting. One, converting long-term plans into short-term actions. Long-term plan is the strategic plan of the organization. So budgeting now, you convert it into short-term action in an annual basis that will be moving towards achieving the overall long-term plans of this organization. Then two, linking planning to organizational strategies. You link the planning to the organizational strategies because the main aim is to achieve the organizational strategies. Then coordinating organizational actions, which is also known as the goal congress, bringing all departments, all units in the organization towards achieving the same aim and objectives of the organization. Then communication of plans. Through budgeting, you communicate the plans of the organization to each department, to each managers and employees in the organization. Communicate the plans of the organization to the employees and managers through budget. Motivating employees and managers by setting targets. Organizations often reward and give bonuses to managers and employees who are able to meet and supersede targets. Then providing guidelines for expenditure authorization. Another importance of the budgeting system is providing guidelines for expenditure authorization. There is deep explanation of how expenditure will be incurred in the organization and the authorization of such expenditure. What amount is allocated to what activities? And you cannot spend beyond what is being allocated to that activities in the budget, except if there is need and there is supplementary budget. You can't go beyond what has been budgeted for on the particular activities. Then defining responsibility for plan implementation. The importance of the budget is that it defines responsibility. The responsibility of each manager and employee on the implementations of the budget plan. Then providing a benchmark for performance evaluation. The budget provides benchmark in comparing the actual and the budgeted figure. So from there, you carry out what we call variance analysis. So you compare the performance. Then resource allocation. Through budget, you allocate resources to different activities. Then cost control and efficiency. You use it to control cost. You know what has been budgeted for. If in the cost of executing those activities, you find out that, for example, 10 naira is budgeted and 15 naira is end up being spent on that activity, then it calls for investigation. You investigate the cost of the additional 5 naira. So thereby, this will allow for cost control. You take corrective measures, control cost. Then strategic decision making. It contains the strategic plan of the organization. So it is therefore used in strategic decision. So the next thing is budget officer. Who is budget officer? The budget officer is the management accountant or the head of the accounting function, tasked with the coordinating the budgeting process on behalf of the budget committee. So is the officer is referred to as budget officer. The officer that is in charge, the management accountant or the head of the accounting function that is tasked with coordinating the budget process is the budget officer. Then budget manual. A budget manual is a comprehensive document that provides detailed guidelines, instructions, and procedures for the entire budgeting process within an organization. So the manual that provides this comprehensive document that provide detailed guidelines and instructions, procedures for the entire budget process. The entire budget process is the budget manual. The document is referred to as budget manual. Then we have the master budget. The master budget. The master budget is the final approved budget. It is usually presented in the form of financial statement, a budgeted income statement, and a budgeted statement of financial position for the end of the financial year. So the master budget is presented in form of financial statement and statement of financial position, and it is the final approved budget organizations will work with. Then we have functional budgets. A functional budget is a budget for a particular aspect of the entity's operation. The functional budget that are prepared vary with the type of business and industries. So this functional budget varies with business and industries. Different types of business and different types of industries have a way of preparing their functional budgets. But for the purpose of this class, we are going to take a manufacturing setup, the manufacturing industry. So now let's look at this functional budget. When preparing functional budget, these are some of the budgets you will be preparing. The sales budget, production budget, budget for production resources cost, such as materials cost, budget, and labor cost budget. Then D, a material purchase budget. Then expenditure budget for every overhead cost center and general overhead cost. Then in preparing budgets, there is what we call the principal budget factor. And this principal budget factor is key in preparing budget. It is also called the key budget factor. It is also called the key budget factor. The key budget factor is the factor in the budget that will set a limit to the volume and scale of operations. So it is this principal budget factors that set a limit to the scale of operations of an organization. So it stands as a constraint. It stands as a constraint. The budget, the principal budget factor stands as a constraint. And usually it comes in sales and other means. So now we are going to take an example to see how you prepare a functional budget. Example, Inugu Plastic Limited makes and sells two products, product P and product Q. Its sales budget for next year is to sell 2,000 units of product P and at a sales price of 400 naira per unit, and 3,000 units of product Q at a sales price of 500 naira per unit. So if you look at this from this question, our principal budget factors here is sales. We can only sell 2,000 units of product P and then 3,000 units of product Q. So this now has set the limit. This now has set the limit for our productions and our sales. We cannot produce what we cannot sell. So the limit now has been set. So the first here is the principal budget factor. So now let's look at this. So to prepare this functional budget from this data, and in preparing functional budget, you have to prepare it in order because you will be needing information. Okay. Good. From one stage to be used in the order in the following stage. So now look at it. The requirement here is for us to prepare a functional budget. That is the requirement for us to prepare a functional budget. Then look at this. We know our principal budget factors is sales. Then the following cost confirmation is expected to apply in the next year. So this is the information that will be applied in preparing the functional budget. So now we have the direct materials. Material A at 40 naira per kg, material B at 50 naira per kg, and material C at 70 naira per kg. And then we have the usage. We use 2 kg of material A in producing product P, and we use 0.5 kg of material B in producing product P, and we use 1 kg of material C to produce product P. So now the cost of materials in producing product P will come from material A, B, and C. So now 40 naira for material A per kg, and we are using 2 kgs. So 40 times 2 will have 80 naira. So we'll be spending 80 naira on material A in producing product P. And then we'll be spending 50 naira multiplied by 0.5, we'll have 25 naira. So we'll be spending 25 naira on material B in producing product P. And then for material C, 70 naira times the 1 kg is 70 naira. So we'll be spending 70 naira on material C in the production of product P. So the total cost of direct material in producing product P is 175 naira. 175 naira. And then for product Q, we have the usage in kg. To produce product Q, you need 0.5 kg of material A, which costs 40 naira per kg. So 40 naira times 0.5, you have 20 naira. So you'll be spending 20 naira on material A in producing product Q. Then material B, you need 3 kgs of material B to produce product Q. And the cost of this material is 50 naira per kg. So 50 multiplied by 3, you have 150 naira. So you'll be spending 150 naira on material B to produce product Q. And then for material C, in the production of product Q, you don't need material C. You don't need material C. Material C is only used in producing product P. When it comes to product Q, we don't use material C. That is why it is 0 here. So here also will be 0. Then direct labor. Direct labor. We have 2 types of labor that will be used in this production. We have grade X and grade Y. And the price for grade X is 100 naira per hour. If you are using grade X labor, you'll be paying 100 naira per labor hour. And if you are using grade Y, if you are using grade Y labor, you'll be paying 80 naira per hour. And in the production of product Q, the hour you need in producing product Q, for grade X, you need 0.25. And the same for product Y, you need 0.25. So the cost will be 100 naira multiplied by 0.25. So you for grade X, in the production of product P, you will be paying 25 naira. You'll be spending 25 naira. And then for grade Y, in the production of product P, 80 times 0.25 is 20 naira. So you'll be spending 20 naira on labor grade Y in the production of product P. So the total labor cost for the production of product P is 45 naira. So now your direct labor cost, your direct cost now, the material cost and the labor cost for the production of product P, you sum these together, the total for material and the total for labor, 175 plus 45, that will give you 200 naira. So this is the unit cost of product P, 220 naira. Then for product Q, this is the labor hour that is used in the production of product Q. The usage hours. For grade labor X, you will need 0.5 to produce product Q. And for grade labor Y, you need 0.75 for the production of product Q. So the cost will be 100 naira by 0.5. You will have 50 naira. So you spend 50 naira on grade labor X in the production of product Q. And then 80 multiplied by 0.75, 60 naira. So you'll be spending 60 naira on grade labor Y in the production of product Q. Then the following opening and closing inventories are budgeted. So look at it here. The next thing is the closing and opening and closing inventories. So this is the budget for the closing and opening inventories. Finished goods, P and Q, the cost unit. This is the opening. And then this is the closing. So for the opening for P is 220. Sorry, this is the cost. The cost 220, and then for Q is 280. Then the unit of the opening is 200 for Q, and then for P 200, and then Q 150. Then the total of the opening stock of finished goods or opening inventory of finished goods for P is 220 times 200. That will give us 44,000. And then for Q, 280 multiplied by 150, you have 42,000. And for the closing, For the closing, we have the unit of P 300 and Q 100. So the total will be the cost, which is 220 for P, multiplied by the unit of closing inventory of P, which is 300. So 220 times 300 will give us 66,000. And then for Q, 280 naira multiplied by 100 will give us 28,000. So the total cost of finished goods of P and Q is 86,000 opening inventory, and then the total for the closing inventory of finished goods is 94,000. Then for material, the inventory for material A, B, and C, the cost is 40 naira for A, 50 naira for B, and 70 naira for C. Then the opening inventory for material A is 500, material B is 550, material C is 100. So the total cost, material A cost 40 naira, 500 kg, 40 multiplied by 500 will have 20,000 kg. 20,000 naira, sorry, 20,000 naira. Then for material B, 50 naira by 550 kg, we have 27 naira 50 kobo. Then material C, 70 naira at 70 naira for 100 kg, we have 7,000 naira. And for the closing inventory, for material A, we have 600 at the cost of 40 naira. 600 by 40 will have 24,000. Then for material B, we have 400 at the cost of 50 naira per material. So the total cost for material B will be 20,000. Then material C is cost 70 naira, and we have the closing inventory of 250 naira. So 70 by 250, the total value of material C in the closing inventory is 17,500. So the total of material A, B, and C closing inventory is 61,500. Then for the opening of material A, B, and C is 54,500. Then to get the total volume of the opening material for both finished goods and materials, the total closing inventories for finished goods and materials, you will have the total of finished goods 86,000 and the total of material 54,500. If you add them together, you have 140,500. That is the total inventory. That is the total opening inventory. Then now for the closing inventory, you now also add the opening inventory of finished goods with the opening inventory of material, 94,000 plus 61,500. That will give you total closing inventory of 155,500. So now we are trying to prepare a functional budget from this. So now if you are to prepare a functional budget, this is what you will do. Let's go. The first budget will be preparing. So we prepare the sales budget first. So now we put normal number one, which is sales budget. So how do we prepare sales budget? How do we prepare sales budget now? To prepare sales budget, we will look at this budgeted quantity of sales. The budgeted quantity So now what is the sales budgeted quantity? Product P and product Q. These are our products. We have product, and these are product P and product Q. And then the budgeted quantity of project P the budgeted quantity in units versus the budgeted price. And that will give us total sales, or that will give us sales revenue. And also, it will be a budgeted, budgeted sales revenue. So now let's see the quantity. Product P, 2,400 naira. Product P, 2,000 quantity at 400 naira. Then product Q. Let's see the quantity of product Q. 3,000 units at 500 naira. 3,000 units at 500 naira. So this will give us, with this we can determine our revenue. So now the revenue for products, the revenue from product P will be 2,000, that's the total budgeted quantity unit by the unit price. So 2,000 multiplied by 400. 2,000 times 400. That will give us 2,000 times 400. That will give us 800,000. So this will be the revenue from the sales of product P. This will be the revenue from sales of product P. Then now we look at product Q. The sales from product Q, the sales of product Q. And then we have 3,000 multiplied by 500. That will give us 1.5. So now this is it. Then the total revenue will be by adding 800 plus 1.5. And that will give us 2.3 million. So this is the sales budget. 2.3. So this is the sales budget. This is sales budget. So the next thing we'll be looking at the production budget. So now the next thing we'll be looking at is the production budget. Production budget. So now we have our first, our sales, budgeted sales. We have our budgeted sales for product P and product Q. And then for product P, we have 2,000. For Q, we have 3,000. And then we have closing inventory. We will add our closing inventory. Closing inventory for product Q. This is it, finished product. Product Q. Closing inventory is 300. And for product P, 300. For product Q, 100. So you come back here, closing inventory for P is 300. And for Q is 100. So you sum this up, 2,000 plus 300, you have 2,300. And then 3,000 plus 100, you have 3,100. Then the next thing, you will less opening inventory. You less opening inventory. And your opening inventory for P and Q, look at it here, finished goods. P and Q, the opening inventory for P is 200, for Q is 150. 200, 2, 200, and then 150. So now you find the difference for P 200, 300 minus 200, we have 2,100. Then for Q, we have 3,100 minus 150. Okay, this is the production budget. This is the production budget. So the next thing now, we're looking at the resources. We have to follow it in order. After the production budget, production, So now let's look at material usage budget. Sorry for the interruption, please. Let's look at material usage budget. We are done with the production budget. We are done with the production budget. So now we will look at the material usage budget. So in the material usage budget, in the material usage budget, we have three materials. We have material A, B, material A, material B, and material C. So in the material usage budget, we have material A in kg, then material B in kg, then material C in kg. So now for material for product B, for product B, we produce the production for product B from our production budget. That's why I say you have to prepare this budget in order because you will need the input from another one to the other one to be prepared. Now look at it. You need this production budget as an input in the preparation of usage, material usage budget. So this is our material usage. We have 2,100 of C and 2,150 of C. So now we come back here and say 2,100, 2,100 units of what is the price of material A? The quantity of material A used in producing P. What is the material? This is material A. How 2 kg. 2 kg of material A is used in the production of product P. So now we take it, we said multiply by 2 kg to produce this 2,100 units. You need 2 kg of material A. And then 2,100 times 2,100 units times 2 kg. That will give us 4,200 kg. This is okay. Then material B is 2,100 units multiplied by the units, the kg needs material P, 0.5 kg production of product P. So we are taking 0.5. 0.5 kg. So 2,100 0.5 we'll have 1,050. This is for material B. Then for material C, 2,100 units of production by 1 kg. Material C is 1 kg. 1 kg of material C is needed in the production of A. So now we have it. So now 2,100 multiplied by 1 kg. We will have 2,100 kg. This is for product P. Then for product Q, for product Q, this is it. For the product Q, this is the production budget. Product Q is 2,950. 2,950 of product Q. So we have 2,950 units multiplied by what is the unit of Q needed in the production of Q? Material A, 0.5 kg is needed in the production of product Q. So we are multiplying by 0.5. 0.5 kg. So 2,000, that's for material A. So 2,950 times 0.5. We'll have 1,475 kg of material A. Then for material B, in the production of product 2,950 units multiplied by, let's see how many kg is needed. 3 kg. For material B, 3 kg. And for material C, we don't need material C in the production of product Q. So we'll only stop here for materials. Material B, 3 kg is needed for the production of Q. So now we come back here for the unit production of Q, we need 3 kg. So now 250 multiplied by 3 kg. That will give us 8,850. For B, 8,850. And for material C, we don't need material C. 2,950 units. If you multiply it by 0 kg, is still 0. You multiply it by 0 kg, it will give you 0. So now we'll sum up this together to have the total material usage. This will give us the total material usage. So the total material usage, 4,200 plus 1,475. We'll have 5,675. Then 1,050 plus 8,850 will have 1,900. Then 2,100 plus 0 is 2,100. We have 2,100. So now let's multiply this. Sorry, let me take off this. We'll multiply it by 2. These are the costs. Okay. So now what is the cost per kg? So cost per kg of this item. Let's see the cost per kg. For material A, B, and C, the cost per kg. This is the cost per kg for material A, B, and C. 40, 50, and 70. 40, 50, and 70 naira. Material A is 40 naira. 40 naira. Material B, 50 naira. Material C, 70 naira. So if you multiply this, we'll have the cost 5,675 times 40 naira. This will give us 2,270 naira. This will be the cost of material A. Total cost of material A for this production, 2,270 naira. Then for material B, 1,900 multiplied by 50 naira. We'll have 95,000 naira for material B, 95,000 naira. Then for material C, there are 2,100 multiplied by 70 naira. We'll have 147 naira. One four seven, 147,000 naira. The total now, sum of the three, 147 plus 95,000 plus 2,270,000. Sorry, this is 287,000. Good. 287,000. So 227,000 plus 95,000 plus 147,000. That will give us 469,000. So the total is 469,000. So this is it. This is material usage budget. So the next thing, we'll be computing material purchase budget. We'll be looking at the material purchase budget. The material purchase budget. Since we know the material usage, so with the material usage now we can compute the material purchase budget. So now let's look at the material purchase budget. Material material purchase budget. Material purchase budget. So now we know our material usage. So the material usage for A, B, and C. A, B, and C. So the usage Material purchase budget. The usage for A is 5,675. Then for B, 1,900. Then for C, 2,100. This is the material usage. So now we have the opening and the closing inventory. We have opening and closing inventory. So now we add the closing inventory. Let's look at the closing inventory of material A, B, and C. The closing inventory. Closing inventory of material. Material A 600, material B 400, and material C 250. 600, 400, and 250. A 600, B 400, C 250. So now we sum it together. 5,675 plus 600. That will give us 6,275. Then for B, 1,900 plus 400. That will give us 2,300. And for material C, 2,100 plus 250. That will give us 2,350. Then the next thing now, you less the opening inventory. Opening inventory. Opening inventory. So let's see the value of the opening inventory of the opening inventory of materials. This is it. Materials A, B, C. We've taken the closing inventory, now the opening inventory. 500 for A, 550 for B, and 100 for C. 500, 550, and 100. A is 500. 500. And then B, 550. 550. 100. C is 100. So now the difference between this will give us the material purchase budget. So now 6,270, 6,275 minus 500. That will give us 5,775. Then for material C, 2,300 minus 550. That will give us 1,750. Then for material C, 2,250 minus 100 will give us 2,250. For material C, Okay, material C. This is it. So now what is the cost of this material? Let's find the cost of this material. So the cost, this is the cost of the material, 40, 50, 70. 40, 50, 70 for material A, 40 naira for material B, 50 naira for material C, 70 naira. Material A, sorry, is what? 40 naira. Material A, 40 naira. Material B, 50 naira. And then C, 70 naira. So the total, so for material A, we have 5,775 times 40 naira. That will give us 231,000 naira. naira. And for material B, we have 1,750 times 50 naira. That will give us 87,500 naira. 87,500 naira. And then for material C, 2,250 times 70 naira. That will give us 157,500 naira. Then the total, when you sum up this together, so the total of these three will give us 157,500 plus 87,500 plus 231,000. That will give us a total of 476,000 naira. Sorry. Let me put the naira sign. Good. 476,000 naira. So this is the purchase, material purchase. This is the purchase. We've determined about three. We've looked at the sales budget. We've determined the sales budget, material usage, material purchase. This material, this two, let me put the naira sign here. Good. So the next thing now, let's look at the labor usage. Direct labor usage. Let's look at the label now. Okay. Now, well, label is grade. Grade 1, sorry, grade X and grade Y. Okay, sorry, please. Let's this break. Okay, the label usage now. The label usage budget. The label usage budget. Then we will look at our production budget. Okay, we produce 2,100 of P and 2,950 of Q. So the labor usage, we will have usage to make 2,100. That is of P. 2,100 units of P. And we have the label in grade X and grade Y. We have the label in grade X and grade Y. This is it. Direct label usage In the production of product P, 0.25 of grade X and 0.25 of grade Y. Right. Grade X and grade Y. And then the production budget. Look at the production budget. The production budget. We have total production for P to be 2,100 and total production for Q to be 2,950 naira. So now you are taking this. Then you have the grade. We have labor grade X and labor grade Y. So now for the X, if you are producing the 1,000 units of P, units P using grade X, using grade X, using grade X, look at it here. If you are using grade X, you will use 0.25 hours. 0.25 hours. So the 0.25 hours in the per unit. So for the 2,100 units, you multiply this by 0.25 hours. That is for X. You said 2,100 times 0.25. You will have 525. Then for grade Y, that will still be used in the production of product P. The same 2,100 units multiplied by, let's see for grade Y. For grade Y. For grade Y in the production of P, the same 0.25 hours is needed. For Y, we still have the same 0.25. So we said for product P, another 0.25. So this will still give us 525. Then for the production of product Q, let's have the quantity of product Q from the production budget. Look at it here. It's 2,950. 2,950. Then you come for Q, usage to produce 2,950 units of product Q. So now 2,950 units of product Q. So let's see how many hours is needed for product Q. The grade X, the grade X for Q is 0.5. 0.5 is needed for grade X in the production of product Q. So now you have 0.5. 0.5. Then 2,900 2,950 multiplied by 0.5. This will give us 1,000 for grade X, 1,475. This is for grade X. Then for grade Y, 2,950 units by, then for grade Y, For grade Y, how many labor hours do we need in the production of grade Y? In the production of product Q, how many hours of grade Y do we need? 0.75. We need 0.75 hours of grade labor Y in the production of product Q. So we have 0.75. Zero point 0.75. So 2,950 multiplied by 0.75. You will have 22,212.5. So approximately, let's have 2,213. So this is the labor hours. So now let's sum up the labor hours for grade X. For grade X that will be used in the production of product P and Q, we have 525 plus 1475. So we have a total of 2,000. And then for grade Y, in the production of product P and Q, we have 525 plus 2,213. We'll have 2,738. So now to produce 2,100 units of product P and then 2,950 units of product Q, you need 2,000 hours of grade labor X and 2,738 hours of grade labor Y. So now let's see the cost. Let's see the cost. So now what is the cost of each of these grades, labor grades? Let's see. Grade Y is 100 naira and grade X. Grade X is 100 naira per hour and grade Y is 80 naira per hour. So now for grade X is 100 naira per hour and Y is 80 naira. So we come back here. This is grade X. This is grade X and 2,000 hours is needed and it costs 100 naira per hour. It costs 100 naira per hour. We have 100 naira. And for grade Y is 80 naira per hour. So now this will give us what will be the total cost now? For grade labor X, we have 2,000 hours times 100 naira. We will have 200,000 naira. So 200,000 naira will be spent for these 200 hours. 200,000. Then for these 2,000 hours, 200,000 will be spent. Then we have for grade labor Y. For grade labor Y, we have 2,738 times 80 naira. This will give us 219,040 naira. So the total now, the total will be for us to sum up the two. 200,000 plus 219,040 naira. And this will give us a total of 419,040 naira. So this is the labor usage budget. This is the labor usage budget. This is the labor usage budget. So now we have the total cost. Total cost for this. So this is the functional budget. This is the functional budget. This is how you prepare functional budget. When you prepare the sales budget, the first sales budget, production budget, sales budget, production budget, material purchase budget, labor usage budget. Then this is what you get. Then now you can use this to prepare the final budget. You can use this functional budget to prepare the final budget. So now let's try it. Let's use this to prepare the final budget and see. We have budgeted profit or loss account. It's for the year ended. So now from this, the first thing is our sales. The first item here is our sales. And what is the value of this sales? As determined earlier. What is the value of our sales? Our total sales is what? Let's look at it. Where is the sales budget? Where is the sales budget? This is the sales budget. Our sales is 2,300,000. So we keep 2,300,000. This is our sales. 2,300,000. So the next thing is the cost of sales. How do you determine cost of sales? So the cost of sales now, we will need our opening inventory. The opening inventory. Opening inventory. Then we'll add our purchases. We'll add our purchases. We'll add our purchases. And we'll also add our labor usage. is also a cost. This is a direct cost. Our labor usage. So now let's pick this item and see what is our opening inventory. Okay, this is purchase budget. This is our purchase. Let's see, where is our inventory? Okay, we have our opening inventory. Let's determine our opening inventory. Opening inventory. Opening inventory. Opening inventory. We have our finished goods. This finished goods. This is the opening inventory. This is the opening inventory for P and Q. So we have 220 by 200 is equal to 220 by 200. We have 44,000. This is for product P. And then for Q, we have the opening inventory at 280. And the unit of the opening inventory is 150. So 280 plus 150. 280 times 150. We have 42,000. And then we have our opening inventories of materials too. The opening inventories of materials. We have material A, material B, material C. Material A, material B, and material C. So now for A, the opening is at 40 naira by 500 is equal to equal to 20,000. Then for C, we have 50 naira by 550 is equal to 27,500. Then for material C, we have 70 by 100 is equal to 7,000. So if we sum this up, it will give us the same as this 86 plus 54,000, which is 140,500. Let's try it and see. 44,000 plus 42,000 plus 20,000 plus 27,000 plus 7,000. $44,000 plus 42,000 plus 20,000 plus 20 plus 27,500 plus 7,000. That will give us 140,500. So this is the opening inventory. You pick this 140,500. When you solve this, this is the opening inventory for finished goods and for the raw material. So 140,500 is the opening. Opening inventory, we have 140,500. And then our purchase from our purchase budget. This is material purchase budget. So the total purchase budget here is 476,000. So our purchase is 476,000. 476,000. And then labor usage. Our labor usage, this is our labor usage, 419,000. 40 naira. So now the total of this, let's sum it up and see. Sorry. So this plus this will give us 1,035,400 for 540. So the next thing now, we are going to remove closing inventory. And then this is the closing inventory. This is the closing inventory for finished goods. When you say 220, the cost multiplied by the unit 300, you have 66,000. 280 multiplied by the unit of the closing 100, 280 times 100, you have 28,000. So for the finished goods, it's 94,000. Then for materials, the closing for material A, 40,000 by the unit 60, you have 24,000. Then material B, 50 by the unit 400, you have 20,000. And then C, cost 17 naira per unit per kg. And then for the kg, for 250 kg, you have 17,500. So the total closing inventory is for the finishing goods and the raw materials, which is 155,500. 155,500. So you come here, you put in 155,500. So now if we remove this 155 from this 1,035,540 minus 155,500, we'll be left with this is the cost of sales. Our cost of sales will be 880,040. So this is our cost of sales. So now the difference will give us the profit or loss. So the budgeted gross profit or loss, the sales, that is 2,000,000 minus this 880,040 naira. Let's minus it and see what we will get. So this will give us 1,419,960 naira. So this is the budgeted gross profit. So this is master budget. This is the master budget. And the ones we prepared first earlier is the functional budget. We prepare functional budget and the master budget. So that is it on budget. That is it for the day. So see you next week.